In this video, traders, we're going to look at what is a limit on market order. Is this the end to slippage? Stay tuned. Hey traders, warm welcome to you. So in advanced order types, we look at some advanced order types with the more professional institutional grade platforms that are used by prop traders, that are used by institutions, that are used by a more serious and active trader. And what we do is we look at those advanced order types, we kind of look, dissect and see what it is, and then work out how we can create that synthetically with our trading platform, whether we're spread betting, whether we're CFD trading, whatever it may be, and see if it's something we want to integrate into our trading setups and strategies. Right, so this one is slightly different. This one is reasonably interesting. People are generally pretty concerned about slippage, right? The conversations I have with traders is, I'm worried about slippage. It's about newer traders who haven't got the experience to have experienced any slippage or not slippage, or don't really have any data to work off. But listen, I've heard about slippage. I'm worried about it. What is it all about? So quick recap. I've done a video on slippage exclusively before, but as an example, let's say you've got a buy stop here, and this is at a 50 level, right? So your order says buy, let's stick with a spread betting example, buy £10 a point, buy stop at 50, whatever the market may be, irrelevant. Now that means that as the price trades at 50, your buy stop is triggered, and it's a traditional buy stop market order means that if you hit 50, if the price hits 50, then your order is executed at market. So price could be going up. If it goes quickly, by the time it hits 50, the price could be trading at 51. Your buy stop is filled at 51 as opposed to 50. That's your slippage. It's 1 point slippage, £1 slippage, whatever unit we've got there. And it's the same if we had an order as well. If we're putting a market order in, we'd be hitting the market at 50, and the time we hit the order it's 50, the market might have moved and we might get filled at 51 even if we're doing a market order, which is basically what a stop is. A stop is like if it's a stop market, it's an automated market order that triggers when a key level is there. It's no different to if we see 50 print and we hit the buy market button. Yes, there might be some slight speed differences, but you get the point. Okay, so that's slippage. So what is a limit on a market order? So a limit on a market order is basically saying, hey, listen, if I put a market order in, then I want to limit the amount of slippage I get. So, and actually, interesting guys, is some spread betting firms and some CFD firms, some spot firms will allow you to set this, but I'm going to talk about in a second why really it's not that important, but it's worth bearing in mind. So a limit on market order basically says, okay, if I'm going to have my market order going in at 50, I never want to pay more than 3 ticks, for example. Let's use this as ticks. I never want to pay, assume that is ticks, I never want to pay more than 3 ticks more than the price the market was hit at. So if the order gets fired in at 50, I don't want to be getting filled at 54, 55, 56. The maximum I'm willing to get slipped by is 3. And so the maximum I'm willing to pay on this is 3. So you'd put into the limit, natively into this synthetic limit that we see on some platforms, hey, the limit would be 3 ticks above the market or 3 ticks below the market or 3 cents or whatever market you're trading. So really what would happen is if the market had ripped straight through and it couldn't fill you anything less than 53 or less, you just wouldn't get filled. So of course the downside of that is that you might still be in a position. If this was a stop, you might not get in a position if you're trying to get in a position. So there's downsides to it. It's not a free lunch, so to speak. But the upside, of course, is that you're not going to get slipped on a wick. You're actually going to be sitting there and you're going to get filled at a price that's a bit more reasonable. So you're not going to get caught out by heavy slippage, which may be more important for getting in as opposed to getting out. So perhaps you just want to get out of the trade regardless. But if you want to get into the trade, then every tick counts. You don't want to be slipped massively. So why is this? So some actual CFD brokers and spread betting brokers do allow you to set that. They call it slightly different things, but they allow you to set different parameters for how much slippage you can allow. Now, the important thing to note, guys, is if you're trading stuff like Euro, US dollar, any of the major currency pairs, and you're not trading a massive size, you're not going to get slipped by that much unless there's some significant news coming out, in which case this probably isn't going to help you and it's just not going to get you into the position. Because if a significant news comes out and the market just rips through, let's imagine the floor for 1.2 floor ceiling for Euro Swiss, was lifted, then the whole thing just collapsed through, and regardless of what you've got set on here, you're going to get massive slippage if you go to market, or you're not going to get filled. So very rare examples, but for day-to-day trading, especially if you're intraday trading or you're swing trading and you're trading reasonable size and you're executing orders during normal market hours, not some middle of the night for both currency pairs or something, then you're not going to be slipped massively. Just one thing to note, guys, in the middle of the night for both currency pairs, the spread's going to be wider anyway, so you probably need to be cautious about executing at times like that, and that's when you might get slippage. But if you imagine you're trading USD GBP during GBP USD, should I say, or USD JPY during the hours those exchanges are open, you're not going to get slipped. You're not going to get slipped by much. Same if you're trading the Dow during those hours, same if you're trading the DAX, same if you're trading some of the thicker shares. You're trading some thinner shares, then yeah, you might get slipped if market is moving. So the general rule is slippage will occur if you have illiquidity and news, or news. If you've got both, then you're going to get slipped. One or the other, you may get slipped. But if you're trading the bigger stuff, bigger liquid things, you don't have to worry about it too much. And also, you've got to think the time frame you're trading on. If you're really trading minute time frame, then this makes a difference between winning and losing. And this is why these platforms sometimes have this integrated natively, because a lot of these guys are trading, very aggressively spread trading. But if you're trading over a several hour time frame, several day time frame, a little bit of slippage here and there isn't probably going to be that much of an issue unless it starts to become frequent. Of course, then you can monitor it and say, hey, I'm getting slipped all the time. Maybe I need to change brokers. And if you do, check out the description below. But if you get that, then you might think, well, actually, what's going on here? Why am I getting slipped all the time? But majority of the time, you're going to be okay.